Welcome to the second of our Finance for Expat webinar series. This one, Retiring in Europe and How to Plan Your Retirement Effectively. This webinar will be presented by Randal Stevens of SJB Global, and the webinar will provide an insight into investing in Europe and retirement planning for expats. We're here to answer any questions you may have. So please submit any questions using the link on your screen. We will answer whatever we can during the webinar, and any that we're not able to answer, we will send by email after the event. If you have any questions, then please send them to me at expats@expatnetwork.com. And obviously, if you're watching the recording, then use expats@expatnetwork.com to pass any questions over, and also if you want to get in touch with SJB Global, if you don't pick up the contact details that they'll provide at the end of their webinar. Right, well, now it's over to Randal. Randal, if you'd like to introduce yourself and take us away. Thanks.
Yeah, no, of course. Thanks, Nigel. So yeah, my name's Randal Stevens. I'm one of the senior advisors at SJB Global. I'll discuss more towards the end of the presentation about my company, how our review process works. But myself, I've been based in Spain for just over 7 years now. Been with SJB Global for just over 5 years since the beginning of the company. And today's webinar is discussing how to plan your retirement effectively in the EU. So I'll just jump straight on. So first point really is, where in the EU are you planning to retire and why? So the three main countries we actually experience the largest amount of people retiring is France, Spain and Portugal. Now, France and Spain both have quite high amount of taxes, but there's always ways to plan around this, and it's always depending on how your income is sourced. Portugal has obviously been a very favourable jurisdiction and a massive favourite since 2009 because of the non-habitual residency scheme. But as a lot of people may be interested in and looking into at the moment, the the NHR scheme has actually just been declared to come to an end from the 1st of January 2024. So this actually means it's no longer going to be the low tax jurisdiction that it has been. And, you know, the NHR scheme had pension income taxed at 10% and in certain circumstances income taxed at 20%. Instead, tax rates are going to be going from a minimum 14.5% up to the maximum of 48%. So that's going to have quite a large impact on people deciding whether to move there. But I would say if you're still looking into that or in the process at the moment, to discuss with people that are able to, gain the visa, whether, it's the application process first off starting that will still enable you to get that, or whether, the timeframes now up until the 1st of January is no longer possible. Often overlooked though, in terms of the EU, is some other countries that do offer really good tax incentives for retirement, and Cyprus and Greece actually offer really good tax incentives for retirees. Greece have a retirement visa in place where tax can be 7% in terms of income, and Cyprus also has the possibility to have foreign pensions, personal pensions, not government pensions or from civil service, taxed, can be chosen to be taxed at a rate of 5%. These actually arguably, these two countries are better than NHR non-habitual residency was actually anyway in a place, because the tax rate is lower, and actually the CGT, capital gains tax rates, are actually lower or none at all in these countries. But it may be as well some people on here that are not just looking for retirement, and they might actually be phasing retirement and still have work on either a contract basis or, have an overseas company, where they still got income coming in from employment. So the tax treatment of income could be different from investment and retirement accounts, and that also needs to be considered, looked into and planned prior to moving. In terms of other countries where, this can be beneficial to consider, perhaps not as warm and sunny as the Portugal and France is there, but Eastern Europe has some really good countries in terms of personal rates of taxation. Hungary, Bulgaria, 2 countries as well, often perhaps overlooked. If people are still working and able to work remotely as well, looking into visas that are coming into place at the moment, rather than just retirement visas, but working visas as well, offer some, different tax incentives and tax benefits. Spain, whilst seen as perhaps having higher rates of taxation, if you're a normal resident there, in terms of income or income from investments, they have placed now a digital nomad visa, which can be eligible for 2 years or a maximum up to 5 years, and that has a flat rate of 24% taxation. So that could actually be a consideration if people are eligible to actually be a very good alternative. But once you've moved and planning to move to these different countries, this is where you need to really plan effectively, first prior to moving, and then also when you've moved as well. So first real important point is, where are you resident before you move? And it's really important that you review and seek advice on the treatment of all your assets you currently hold before you move, so you can plan effectively. Some of these assets, first off, bank accounts, it's probably going to be the lowest implication on a lot of the assets that you do hold, but it doesn't mean it's important to review these and how these will be treated when you actually do move over to another country. First off, at the moment we've got higher interest rates, and if you're benefiting from these, brilliant, great, but you need to see how that interest earned will be taxed in the country that you move to. Is there allowances that you can use up first off before having to pay tax, or will you have to pay tax on all of the interest earned? So that's important to look at and review to see how that fits into your plans. Also, check the bank that you're with to make sure that they'll actually keep the account open if you move overseas. Now, we've had a lot of clients with Barclays who have closed the accounts for people because they've got an overseas account registered on their address. Now, some people that we spoke to and have got clients of have perhaps not kept up to date with that, had that account open with maybe smaller amounts of money in terms of net worth, useful when they go back to the UK, and so they're not having to convert currencies, but then they found out closer that their account's been closed down, and they've got to take time and effort to reclaim that money, put it back into another bank account, and also look at the currency conversions. So a tip from mine for a lot of my clients is to look and consider a Wise, Revolut, N26 bank account. So these are online bank accounts where you can use the currency conversions at a much better rate than what a lot of home banks would offer. So that cuts down on bank fees, and you can have multiple currency accounts within there, switch between them, and then transfer your money over to your Spanish, Portuguese, or French, or other European bank from doing so, but still, converting and keep, US dollars or GBP as well, say, and have investment or pension income paid into that. So you're making the currency conversions at a time that suits you and at rates that suits you as well. So that's a really important strategy and really important thing to look at in terms of bank accounts. The next thing is pensions. And, looking at how your pensions and retirement accounts are actually going to be treated when you move overseas. First important point on UK pensions, you may not have reviewed these properly, or you may have just got the paperwork through from your pension provider and it shows that you're going to receive a 25% PCLS, pension commencement lump sum. So you can take up to 25% of the pension tax-free, what it says on the paperwork. But what a lot of people don't actually realize or actually consider is that tax-free element might not be applicable when you've actually moved to another country, and it might only have been applicable if you'd been in the UK on that UK pension. So looking at that, reviewing whether it makes sense to take that prior to moving or not, then yeah, that needs to be discussed with an advisor and planned around to see how that would impact your plans moving forward. For other retirement accounts, if you're a US expat, Roth IRAs, whilst tax-free in the US, this might not all be tax-free when you move to the EU. So again, looking at advice and reviewing advice on those points and seeing what your options are prior to moving, really important to look at to make sure that you're not going to have to pay additional taxes than what you would have had to pay if you'd actually organised or planned for these prior to moving. Another additional consideration on pensions is annuities. And with higher interest rates at the moment, annuities have again come into context and actually seen as a viable option for many people. A lot of pension schemes as well might only offer the option to take an annuity as well, or you would have to transfer if you didn't want to have to purchase one. But if you've moved to the EU or a lot of other countries as well, it's pretty much every annuity provider that we know of won't actually enable you to purchase an annuity once you've moved. So if an annuity was really the option that you're looking to take, of course, that means you're replacing the value of that pension for an income instead. It needs to be really carefully considered to see how that fits in. But now that, with interest rates, again, it's a viable option. If you're looking to do so, planning to do that and looking into it before you move is really important to look at as well. That's a lot on private or maybe workplace pensions, but government pensions in most instances, in most countries, in double taxation agreements between countries means that with most government pensions, and by this I'm talking military, civil service, NHS, some of these types of pensions, they will only be taxable in the country that income arises from. So that should be reviewed as well to see how that fits in, what that income would be if you've got one of these pension schemes, and it can actually fit very well into your tax planning strategies, because if that income is always taxable in the home country, then we can see what income is taxable in the country that you move to and make plans around that. It might actually enable you to lower your overall rate of taxation as a whole from doing so. So some good planning opportunities can be looked at from those fronts. Also, if you're a US expat, it might be the case your 401k or IRA provider will need you to actually transfer to an alternative provider, may not enable you to keep that open when you move countries. So looking at that, planning around that is really important to do to make sure that you're not, once you've moved, if that is the case, then you're not having to scramble around, find a solution, find a company to work with that can find that solution and get that working for you, especially if you're reliant on taking income from there. You don't want to be put in a position where you're against a time frame to find a solution. Next point there is investment and brokerage accounts. Now, this again on the first point here on the side, where are you resident now, is a really important consideration, because where you're resident now might enable you to benefit from utilizing your capital gains tax allowances prior to moving, if it's a case of general investment accounts, or depending on what country you're in, looking at what the capital gains tax is and what the current implications are on your general investment accounts prior to moving, and then reviewing what it would look like when you did move as well. So, for example, I've had clients based in countries such as Switzerland, for example, and either rebasing gains or liquidating investments prior to moving, benefiting from the capital gains rates there prior to moving over to another EU country such as France, Spain, and Portugal, could actually enable you massive tax savings to look at. So seeking advice on those, planning around those, really important. Even if you're in the UK, although CGT capital gains allowances have been reducing over the last few years, there's still allowances that you've got which might be better than what that is prior to moving. So either rebasing some of those gains prior to moving, or looking what the treatment is and reviewing that is really important. Other investment accounts that a lot of people have in the UK is an ISA. Now, in the UK, that's of course tax-free, the income that you take from that, but it's extremely likely, or in pretty much every case, that it's not going to be tax-free when you move to the EU. So planning review around that, really important to, does it make sense to liquidate that prior to moving, rebasing the gains before you do so as well, seeking advice around that it is really important to do so, because we've had so many instances of people moving over with their ISA thinking it would still be tax-free, and it's no longer the case. Great. So if you're a US expat, looking at as well your brokerage accounts, as with the 401k IRA, it might be that your brokerage account also doesn't enable you to keep that open when you're outside of the US and you've moved overseas. So that's really important to look at, review that, just to see whether, again, as with the 401k, that needs to be moved to another brokerage account. And also, of course, would that incur capital gains taxes or anything at that point in time as well? So reviewing that, planning around that is really important. Now, not only just looking at the treatment and what the structure of those are, but also looking at how they're constructed. Are the investment accounts set up on a single basis, or are they between partners? Are they set up as a joint account? That can have really important implications, not only on taxation levels, but also in the event of on death and how these assets are passed on to loved ones. And it's really important that it's reviewed in your will and estate planning to see exactly, how these are detailed, how they're going to be passed on, and to make sure that they can be passed on the best way possible. The next point there is looking at insurance. Do you have life insurance in place? And is this life insurance still going to be applicable and eligible when you've moved to another country? Checking the terms and conditions of your insurance provider, just to make sure that you are still covered, is really important to do, or whether additional insurance needs to be taken out. Additional on the estate planning strategies that you can look at there is looking at, where your domicile will be ongoing in the future, and whether any life insurance would also, when it's paid out, enhance the value of your estate and instead can life insurance be written into trust? A lot of instances it can really easily with wrappers through your insurance provider. So looking and planning around this can be really, really important to look at. The last point here that I've mentioned is property. So in terms of property, one or two ways. First off, residential property. Are you selling your residential property prior to moving country? And at what point will you be then moving to your new country afterwards? That's really important to look at, review in time and get this right, because, for instance, if you sold your property at the beginning of the the calendar year, for example, or which is a lot of tax years in Europe, and then say you moved within the next month afterwards, it could be that you're actually tax resident in your new country for that year ongoing. Now, that could actually mean additional taxation that you weren't aware that you're actually going to be applicable for, because you're now a tax resident in another country, whereas you might not have had capital gains taxes applicable on the primary residence in the first country, but it might be the case on the second country. So, planning around this: when do you move, at what timing, when have you sold investments, assets, properties first off, and then leave that a duration of time to make sure that you're not going to be stung when you move to another country afterwards. And that can be applicable for, a lot of the different things that I talked about here, taking the 25% PCLS from the UK pension, would that be classed as income in that tax year as well? Would have been tax-free in the UK, but planning around these, when to take that income, the duration before you move, really important to look at to make, again, as you're not stung moving to the other country. Great. And the last point is, do you already have a financial advisor or a tax advisor in the country that you're in? First off, discuss these points, have the review with them, discuss your plan to move overseas with them, with these advisors prior to moving. But what we also find is that a lot of financial advisors may no longer be able to provide ongoing advice on either the assets that you hold or new business once you've moved to your new country. It might be the case that they're only able to offer the advice in person, so you might have to travel back and see them physically with your boots on the ground back in your home country to receive the advice. But it might restrict you from doing new pieces of business, or actually being able to set up different investment plans or solutions, which may actually be a benefit for you and actually may make sense. So I'll move on to a lot of these now and looking at the different investment planning strategies we can look at within the EU. So as I've just discussed on a lot of these points, some of the options available to you in your country now might not be available once you've moved, or may no longer be the best fit for you ongoing. So this is where, when you've reviewed those assets, looking at how they'll work and what solutions can you be looking into. So in the three main large countries that I discussed about, where a lot of people move to, France, Spain and Portugal, there's actually compliant investment bonds available within these countries. So these are country-specific investment solutions, which can be really tax-efficient ways of investing. So one of the first points in all of these investments is they allow something called gross roll-up within the structure, which means that, if you're making investment changes within the plan itself, then that wouldn't incur a tax on any of the gain. If you left some of your general investment accounts there and you're making investment changes, you're going to have to calculate what the gain has been and then pay the tax in that year based upon that gain. So this allows gross roll up, and it's not until you actually take income from the plans itself then that actually triggers a tax liability. So some of the tax benefits that can arise from these as well is that, in the case of the Spanish compliant bond, it's a portion of, when you do take an income, a portion of your capital that you originally invested is returned, and then a portion of what you take out is only calculated and tested against the savings tax rates in Spain. So, we can calculate and determine what that would be based upon different growth rates, and then compare that, against general investment accounts to see if that works out at a better rate. In a lot of ways, it will, and can actually be really tax efficient way of investing and then taking the income afterwards. With the Portuguese and French compliant solutions, the longer that you hold these investments, these also benefit from reduced tax rates as well. So really important that, you would look at those sooner rather than later on moving, because if you're planning to retire, remain there a longer time, some of the tax benefits might occur after a period of time, the longer that you hold that as well. So yeah, getting that set up as soon as possible is really important. Now, these plans can also be set up on single or joint bases as well, which again can be possible ways to reduce taxes, but also allow for smooth and safe transitions of these assets upon death as well. So looking at how that's set up and constructed is really important to do. But yeah, there's a lot more specifics on these, and seeing whether they'll be a good fit for people, and that's what we can review as part of a full strategy to see whether that's should be considered or not. Now, if you're moving to other EU countries, or for any instance a compliant solution doesn't actually work out as the best structural opportunity available, we can also look at multi-currency general investment accounts. So we can look up setting up liquid investment platforms with low fees that can be invested into multiple currencies. So again, really important to make sure that investments can be held in the currency of where you move to, can be structured or split between different investment currencies as well, if wanted, to be able to move that over at better rates over different periods of time. Next point there is pension transfers and rollover retirement accounts. So these can be more complex areas and seen really important. Does a pension transfer make sense when you move overseas? And it depends on what type of pensions they are, where the pensions are, and what the solutions would be to compare that against what's available for you. First off, for UK pensions, it depends on what type of UK pension that is. Are they defined benefit schemes? Are they defined contribution, or a mixture of both? So we can compare the benefits and review and compare the benefits of UK pensions, what they provide in their current structure, and then review them against alternatives to see if it's beneficial to leave them where they are or actually consider a transfer. So first off, we look at the most common defined contribution schemes in the UK. It might be a few different reasons that you might actually consider a transfer of these into an alternative scheme. It might be that the scheme that you're in has very limited investment choices, how that is, and a lot of these might be have a heavy weighting towards UK bias, and you might actually want a more diversified global strategy in terms of your investment performance. So we can review that, what the investments you've got eligible are, and compare that against alternative plans, what our portfolios look like. Other reasons for defined contribution schemes is you might actually have to transfer to have flexible drawdown within the plan. You might have restrictions on how you can take that income. You might be forced into taking an annuity, or you might have to take 100% of the pension as a lump sum. So reviewing having that in a more flexible plan, and what a lot of people consider there is a SIPP or a QROPS. Reviewing those options and seeing which one is the best and how that will work for you are really, really important to look at. It might also be that, again, on currency, you want to have your pension invested in another currency as well, so to avoid currency fluctuations. And last point looking on this is how your beneficiaries and loved ones would actually receive the pension in the event of your death. Now, does your pension scheme enable beneficiary pension? And what that is does that allow your loved ones who you designate to take over that pension scheme and keep that invested on the event of your death? Some schemes will, but some schemes won't. And actually, you would be required to take 100% of that pension as a lump sum on the event of death. Now, of course, that can incur much higher rates of taxation if instead that, on the alternative, it was kept invested and income was taken from that instead and continues to receive advice. So looking at those points and reviewing those and how we can help people in the EU are really important to look at. Now, the next point here, PFIT compliant structures for US expats. Now, if you're a US expat, the chances are, unfortunately, I've just talked on a few different points above, some of these might not actually be eligible for yourself because of your status as a US connected person. And with US connected people, it's a lot trickier for them to invest when they move overseas, whether that be the bank account or investment providers that you're with. They'll want a lot of additional forms or procedures put in place to make sure everything's compliant. Now, you have to make sure that whatever you invest into as a US connected person is PFIT compliant to make sure that you're not going to be exposed to higher rates of taxation for having the wrong investment structure. So that's really important to look at, make sure that you've got those structures in place, and it can, it can be a bit more specialized on those, but they're solutions we have in place for US expats. Next point here is state pension benefits. Now, reviewing what your state pension benefits are, how many years that you've got between different countries as well, if you've worked in multiple different countries as well, looking at how all of those be treated, how they'll be amalgamated together are really important, but also whether you can actually make additional voluntary contributions as well, top those up whilst you're still eligible to do so, either prior to moving or when you've moved as well, really important. And now that in the case of UK state pensions, that can differ based upon, your employment status, whether you're still employed or not, on what class rates that you'll pay on making those voluntary contributions. But in most instances, it can be a massive benefit to do so, a real no-brainer to actually make voluntary contributions, and it can make a considerable difference to your retirement plans. So looking at that, reviewing, discussing with an advisor how that can be done, really important to do. And last point here, looking at international estate planning and international wills. So if you're moving between countries, or if you spent your life moving between different countries as well, chances are that you're still going to have assets in different countries. And making sure that all of these are protected for loved ones on your death is very, very important. Setting up an international will or making allowances for estate planning through trust can have considerable differences, and make sure that these assets are either not locked away and they're still accessible on death, or they can be passed really seamlessly to your beneficiaries in the event of that happening is really important. There's instances where we've had clients come to us where assets weren't declared properly in wills or, into their estate plans effectively. And after a year and a half, this is still going through costly probate where they haven't had access to some of the assets or income that they should have actually been eligible for, or if they'd had some planning in place that could have been a lot more effective of how they'd received that. Even in the case of, if people hold individual stocks, there's where are those stocks listed as well, and how are they written into your estate plan and will. There's some articles or podcasts that I've listened to recently where there's untold fortunes holding the US or the Hong Kong, where stocks have been listed on different exchanges, and the cost of gaining the probate and getting those assets back might have actually cost more than what some of the holdings might have been worth. So they've been left from doing so, or a lot of people didn't realize they were there as well, not kept in touch of. So making sure, looking at how everything is constructed, what we talked about on the planning side before you move, but also looking at how that's going to be treated, how it's constructed when you have moved, how it's going to be working for you ongoing is really important to get right. Not only for the tax treatment when you're there, but also how that's going to be passed on and what would happen on those assets in the event of your death. But what if it's then decided that, you've moved to a country, you've retired there 10, 15, 20 years, but after that period of time, things might happen where you want to move back to the country, where you come from. Now, people and plans change. I've reviewed countless and done countless financial plans for people where even if they thought that they did have everything planned as much as possible with really clear plans, there's still so many questions that we've gone through when I go through my plans where a lot of things are very fluid, are up in the air, things can change or people don't know. So it's really important to make sure that anything that you do have in place can also be changed and can be flexible, and all considerations are put into place. So you need to determine if the solutions are portable. If you move to Spain for a period of years, for instance, going back to the first slide, you're in Spain for 5 years, taking advantage of the digital nomad visa. But then after 5 years, you wanted to then fully retire and then move to another country. Would the plans that you put in place be portable in that country when you do so? And making sure that those are best constructed in that way, and always making sure things are portable if you ever move to a third country, or if you move back to your country where you've been to as well. Really important to look at. Now, even if there was no plans to move back, and if something wasn't as portable and it was more tax efficient, first off, if things needed to be changed at all, can they be changed or liquidated without any exit fees if needed? Now, making sure that you work on a fee basis, no tie-ins, commission structures on the solution or the investments itself. really important for these points, because things can change, people can go back. Making sure that you're not going to be adversely affected by anything that happened to you, and the plan changing is really important as well. And the last point is the advisory company that you use. As we talked about, can the advisor still help you if you go back to your move to another country? So making sure that you have all the licenses, the advisory company that you have has licenses in place to provide advice in most other countries as well, that it might be really important to do. Great. So moving on to us and who we are as a company, who are SJB. So SJB, we've got two separate entities. So SJB Global, this covers all countries worldwide, and SJB US, so it's covering the US only. For our Europe entity, we've won 3 awards over the last few years. That's we won the best IFA firm under 3 years old on our 3rd year anniversary just before. So that was a really great achievement to win. The next one we won was Excellence in Professional Development, and that's based upon either ongoing certification and exams that advisors are consistently doing within the company, not just settling on what we need, but pushing ourselves even further into higher levels and exams, but also for an academy that we put into place. Now, I'm a senior advisor here. I've got associate advisors underneath me that I've taught up from entry level and are now progressed through the company, and progressing. One of my associates is very close to becoming a senior advisor, so it's great to have been worked with him, see his development over the years, and see him move up in his development. And the plan that we got in place on that, which we detailed, has won awards for that. And also for digital innovation, for the different structures and tech that we have in place for our clients, to make things seamless for them, no matter where they may be, and how to make things as seamless as possible in today's digital world, where we don't have to see clients face to face as much as possible. It helps us with time, which obviously means less cost as well, which we then pass on to our clients, but also as well making the plans and changes, everything really easy for clients through the digital innovation. We've got over 300 reviews from clients. 95% are over 5 stars and 5% 4 stars. I can see those online. And since we've been established since 2018, and we've got assets of over 150 million GBP. Our client retention rate is 98%, and a really high staff retention rate as well. Really pleased with the client retention rate, especially during a very volatile few years of COVID, interest rate changes, volatility in the markets over the last few years. Being able to detail that to clients, making sure they understand how their portfolio is constructed in line with what's going on with the world. Really important to pass that on to make sure everyone fully understands their position and where they're being, what's best to do throughout these periods. Our regulations are independence and fees. So here we detail a lot of our other regulations through the SEC in the US, ISEC in Cyprus, allows passport across the whole of the EU, Canada, UAE, and also Gibraltar, which allows us passport Middle East, Far East, Africa, South America, UK. Independence, we're not tied to any agent at all. And then based upon, because of this, we can then look across the whole of the market and then offer our solution based upon what we feel is best, based upon reputation, offering, cost, jurisdiction as well. And in terms of the cost, we work on a fee-based model, which very similar to that the UK, where it's based across. it's always the same no matter what we're going to actually recommend. So we're not actually paid based upon what solution that we provide for people. So that gets away any incentive from advisor, which is really, really important to make sure the best advice is given. And as we talked about, areas of help with retirement planning, investment planning, tax planning, pension advice, compliance solutions, and all of these services. Last point here, process. We go through a full fact find, look at liabilities, income, expenditure. Then we produce cash flow planning reports, looking at where you currently are, where you want to be, detailing a breakdown of how all of those different assets can provide income, how that can be treated, the analysis of your current plan. And then once we reviewed all of that, we can make a recommendation based upon, that cash flow planning, your objectives, what you plan to do. We compare them against the alternatives and we produce a personalized recommendation. We look at the pros and cons and we produce a full holistic review overgoing. So that's it for everything today. Thanks very much for listening, everyone. And do you have any questions at all?
Okay, well, thanks very much, Randal. Yes, there are a few questions. The first question is, I'm planning to retire to Spain next year. How do I get my UK state pension? And if you allow me, I'll answer that one because I went through it myself. I was in Spain until recently. And if you're living in the EU and then need to apply for your pension, you have to contact the International Pension Department in the DWP. And there is a form that you can fill in. The problem with that form is that I remember one of the questions is, have you ever lived in the UK? List all of the places where you've ever lived, list all of your employers. What I discovered was that actually if you pick up the phone and speak to them, all of those questions basically go away and you get a much more much quicker set of responses. In my case, I did all that and then heard nothing for several months, and they had told me to allow sort of about 8 weeks, and I didn't get around to doing it a little later. But when I rang up to say what's happening, the guy said to me quite clearly, nothing has happened, apologies, nothing has happened to your file whatsoever. But he said he would put me on the urgent list and it was sorted out in 2 weeks. So my simple advice in terms of getting your state pension sorted is use the phone and chase up by phone, because the forms are quite frankly ridiculous. So
I would, I think that's the best advice there, Nigel. Get on the phone to them as soon is the best way. You can be on hold maybe for 20 to 30 minutes sometimes, but the outcome can actually be a lot better from doing so. But also on that point, I would just check through your state pension entitlements. And if you've got any gaps there, to make sure you do that before you reach state pension age, because you won't be able to top up any gaps after you've gone over that age. And make sure that's done. You've also, for anyone else looking at it as well, you've got up until 2025 to make larger back payments on the state pension. It's just been increased by 2 years to buy back more years, exactly for the reason that Nigel mentioned, is that people were sending in forms and they're not getting a response back for 6 months. So there's been a huge backlog within the system where they've had to increase the time to be able to give everyone the opportunity to do it.
Okay, thanks. I'm going to hear, I've got 4 pension schemes in the UK. I've done some research, and should I transfer these into a SIP or a QROPS?
Right. Yeah, so that's a really good question. So we have a lot of inquiries for people that maybe have done research online. And it's a really popular question that they'll come to. They may have done some first off research and go, right, which one's going to be better for me, a SIP or a QROPS? Now, a lot of the information that you look at online is actually extremely salesy in a lot of ways and may not be all the best information out there. In particular, on AccurOps, there's been a lot of changes to these rules since 2017 and even over the last year or two as well. So some of the information might be outdated. And, with AccurOps, a lot of AccurOps jurisdictions, some of these might not be eligible for people in some countries anymore. And secondly, the lifetime allowance in the UK was frozen this year by the Conservative government, which was one of the major benefits of AccurOps, is that it's got no lifetime allowance. Now, there has been talk to our Labour government, if they come in, will they change the lifetime allowance? But the wheels are in motion. Would that be possible at this point in time? We can only work on what the regulation and laws say at this point in time now to be able to give the best advice, and that should always be the case. But reviewing the two different options should always be done with an advisor, and it's always based upon people's circumstances, objectives, what they've currently got, whether they should transfer. It's not an easy black and white question. So speaking with an advisor, going through all of those different plans, and yeah, if you're interested, you can see my email address there or reach out to us.
Okay. So just one, I spoke to the UK Money Helper Service about moving to overseas, and I'm worried about scams when choosing who I use as an advisor when I move. How can I ensure that I have a good advisor and that they're legitimate?
Yeah, so really good. First off, you spoke to the Money Helper Advisor service. It's a free UK government service that you can do to discuss different assets, income in the UK. And actually, as part of our review process, especially around pensions and stuff like that, we actually refer people to these as part of the process to actually speak with them when if we're recommending a transfer to make sure that they spoke with someone else as well. So it's a good independent voice that they can speak to that could bring up some additional questions as well at any point in time. But I would say that they are, not able to offer personalized advice, and they may be a bit more attuned to maybe UK advice and may not have the expertise of some of the complexities of moving to the EU, the different countries, the rules, regulations that companies need to have in place there, and cross-border between different countries on assets as well to have into place. So on those fronts, I'd always say, look into the companies as much as possible. Look into their online digital footprint. What's their reputation online? What have other clients said about them? And also looking at the way that they work and the process that they're on. Are they considering everything full in depth, or are they just trying to push any specific solution or advice upon people? Have they discounted various options, and why? What is their fee that they charge, and on what basis? Is this fully detailed to people in all of reports, or is there still questions about how that they get their fees or as well? Because if that's the case, and that can be a concern. So making sure everything's detailed, and just ask questions. A good advisor will be able to answer any question, be able to offer links to all of their regulations and everything to be able to do so, and would be comfortable with doing that to make sure anyone's comfortable prior to moving ahead with anything.
Yeah, and so key to ensure that they're properly regulated relative to the market that you're talking about.
Exactly.
Okay, and this one from an American, I believe. I have a 401k in the US and have moved to Portugal. Should I roll this into an IRA, and why would I do that? Yeah,
again, with the question on the UK pensions that come through, it would depend on your circumstances, how your plan currently works, and then comparing that against the two options prior to actually making a recommendation. But in some and a lot of circumstances, is some of the things that we discussed about, this actually could be beneficial to do and to look at. First off, that the 401k might not enable you to keep that open when you've moved. If so, rolling that over can definitely make a sense. Then looking at what your investment structures and options are within the plan. A lot of 401ks that I've reviewed are very limited investment options, and you might only just be able to choose what your risk profile is to have those basket of investments are very, very limited. And in a lot of instances as well, when I've actually reviewed some plans, I can actually reduce costs by actually adding our advice costs on top of that as well, because some plans might cost anywhere up until about 2% for the actual investment solutions within the 401k. So I could add my advice and our portfolio actually at a less cost. So you're actually getting more benefit because you're getting advice as well on top of that at reduced cost. I'd say reach out, have a review, and then we can see whether that's beneficial or not.
Okay. And then one more. I sold my investments cash they're currently benefiting from the higher interest rates. Can I get the same when I move to the EU?
Now, of course, EU rates are different as well. You might be able to have expat accounts where you can actually keep accounts open and still benefit from higher interest rates as well. But whilst it's been really good as well, that interest rates have been really good over the course of the last few years. Still looking at how that fits into your retirement plan. Longer term is really important to do. Are the interest rates that you've got locked in for a period of years, or if interest rates start to decline in maybe a year's time, will that then start to reduce down? And then seeing and comparing against having portions or money invested into the market, what that can do over a longer period of time as part of your investment strategy, really important to do. So whilst it's great that, people can actually have these now by taking no risk, also looking at how it fits in as a longer term plan as well. But you can benefit from these in the EU, but depends on what your currency is. You might want to keep that in other currencies. US dollar and GBP have got higher interest rates than what the EU has got. So maybe you want to keep it in those accounts with the higher interest rate and then make conversions over periods of time as and when needed.
Okay, well, thank you very much, Randal. And just to finish off, well, thank you, Randal. Thank you all for listening. As I said at the beginning, we're here to help. So if you have any questions or you'd like us to refer to one of our network of service providers, obviously, in terms of this, we can refer you to Randal. And if you haven't picked up that email address that's on the screen, you can get us at expats@expatnetwork.com. Obviously, we have people who can help you in other aspects of your move abroad if you're planning to retire. So thank you, and good luck with your planning for your retirement. Okay, thank you very much, Randal. Cheers.
Cheers, Nigel. Thanks.
Bye.